It's the closing bell on Wall Street, and now it's market domination overtime. Jared Blickery going to be along in a moment to get you up to speed on the details from today's trade. I'm going to start with the major averages. Buying into the close. Look at this. We haven't seen this in a little while, right? What we've seen the last couple of weeks is selling into the weekend. Now we've got a little bit of buying here that's sending the Dow to close at its highs of the session, up by 600 points, about 1.4%, and most of that turn upwards coming in the last half hour or so of trading, whereas there's been a lot of volatility triggered by tariff comments over the past couple of weeks or so. There has been some reporting today that Mexico might be willing to match U.S. tariffs on China itself as a way to get its own deal, to avoid its own tariffs. And so perhaps that's something giving the market, heartening the market, perhaps into the weekend. Maybe it's just taking momentum back on. Who knows? But we got the S&P 500 up by 1.6% on the session, and we got the NASDAQ up by 1.6% as well. Is it enough for things to be positive on the week? No, not for the NASDAQ, but I'm sure Jared's got to look at all of the numbers as well under the surface. Hey, Jared.
Well, hey, Julie. Yeah, sometimes at the end of a big month when you've had a big decline or a big gain, you can see some interesting action into the close, and I think that's what we saw today. Some really big funds had to do something, and that it could be as simple as that. Let me show you the 19-day, and that's going to be for the month of February. NASDAQ composite down 4%. That's going to be worse since, I believe, sometime in last year. Without that stick save into the close, it would have been worse since 2023. Taking a look at the S&P 500, down 1.43%. It's not a disaster, but it's still a negative return, something we haven't been used to much of in this bull market. And then the Russell 2000, that's down about 6%. And let's round it out with the Dow down about 1.5%. Moving on to some of the sector action and some of the heat maps here. This is the NASDAQ 100, and you can see what a nice close that delivered for us. NVIDIA up almost 4% there, but we want to get a look at the sector action. All 11 sectors in the red, led by financials and consumer discretionary. I think it's notable that consumer discretionary was the worst performing sector in the month of February, or yes, it was, down 7%. You can see that down in the lower right. Consumer staples, kind of its opposite, maybe its cousin. That was number one, up 5%. Real estate and energy, number 2 and 3. And taking a look, let's look inside the NASDAQ for a month-to-date look real quick, and you can see some of the carnage that we had in some of these big guys. NVIDIA eked out a gain, so did Apple, but Alphabet down 16%, Tesla down 28%. For some of these names, and I believe Amazon down 10%. That was the worst for Amazon and Tesla since December of 2022, and that extends to the entire Mag 7 index. So Amazon and Tesla really kind of gumming up the works for the Mag 7 there. I'm going to close on a potential another bright spot. That's going to be China. Alibaba up 34%, and Josh, you and I are going to get into this in about 30 minutes, some of the deep dive details.
We sure are, Jared. It was a roller coaster day on Wall Street after a contentious meeting between President Trump and President Zelensky, but stocks did rally into the close, this coming amid a backdrop of growing concerns of slowing economic growth, as the latest Atlanta Fed GDP Now estimate shows contraction in the first quarter. Joining us now is Jon Cheigh, Cohen Steers President and Chief Investment Officer. John, it's good to see you here on set.
Josh and Julie, thank you so much for having me here today.
Let's talk, John, about this new macroeconomic regime you talk about. So here's what you say, John. You say stubbornly higher inflation, slower real growth, and higher volatility. That doesn't sound so great, John.
I'm sorry to break the news to you here today. Well, look, first and foremost, our view is investors need to have things like listed real assets and alternative income in their portfolios because it helps offer returns, but also diversification. So this gets at this idea that the future, unsurprisingly, is going to be different than the last 5 or 10 years that we've lived in. It may not be a very fun story, but just like the volatility that we've seen here today, whether it's talking about geopolitics, supply chain, tariffs, and things like that, it's a new game. And policymakers, instead of saying inflation is low, let's just grow the economy, now policymakers have to worry that inflation is higher than they want it to be, that geopolitics and supply chains are becoming very important considerations. So our view is for policymakers and therefore economies, it's just a much trickier game. So what does that mean for investors? It means that even though, of course, everyone thinks they have the right answer, you need to be diversified. And areas like real assets, so those are things like real estate and infrastructure, they go in cycles, just like things like equities have gone in cycles or private equity have gone in cycles. So over the last 10 years, certain areas have had a lot of tailwinds, but then certain areas, frankly, have not done as well, and as a result, valuations have become more attractive. So, as an example, in that kind of new regime, we know equities have done really, really well the last 10 years. That's great, but the more likely outcome is over the next 5 to 10 years, equities may disappoint. And so that means we need to have other asset classes that can help deliver returns. And so our view is an area like real assets could be one of those areas to be part of the diversification.
Now, John, I may be wrong, but I'm guessing that you always think real assets are a good bet, because that's what you guys do, right?
Sure.
So I guess if you can expand a little bit on the role that they should be playing now versus the role they perhaps played in a portfolio over this last 5 years or so when we were seeing stocks really perform.
Sure. So real assets generally, they're going to tend to do well when inflation is going to be a little bit higher. Also, sometimes when the economy is a little bit more, I wouldn't say poor, but I would say less certain, because areas like real estate, but also in particular infrastructure, these companies, they own hard assets and they have what are called contracted income, whether it's a 10-year lease or you're a utility company where I would say the earnings volatility is relatively low. And so in a world where inflation may be a bit higher and where maybe the view of what's GDP going to look like over the next 6, 12, 24 months may be more uncertain, those are typically, that's typically an environment where real assets tend to do better. The last decade, we were in a low inflation world. And so, of course, that wasn't a great environment for things like infrastructure, things like real estate, and things like natural resource equities. So that's why we think we're in a different kind of world. And in that different kind of world, you're going to want to have these kinds of asset classes.
So John, for viewers who are listening right now, they're thinking, John makes a lot of sense. I got to tweak my portfolio here. I'm thinking about REITs, and obviously, what you guys know it better than anybody. What is the REIT outlook for 2025? What do you see?
Sure. So over the last 2 years or so, REITs have done, let's just say, roughly 10% a year. Mm-hmm. Most of the time, you'd say that's pretty good, except for the fact, of course, that the S&P's done 25% a year. Mm-hmm. I would say going forward, we feel earnings growth is actually accelerating for the REIT sector. The biggest reason for that is because new supply. So new supply, and you probably have people, coming here on the show saying it's hard to build new office buildings or it's hard to build new shopping centers. And frankly, tariffs don't make that any easier. When things become more expensive to build, that's bad to be a developer. It's good to be an owner of real estate because that means there's just less new competition. So we've seen new supply come down, and that's why we're seeing accelerating rental growth and income growth. So I'd say that's really the big story for the real estate sector.
Well, and REITs are not all created equal, right? Within real estate investment trusts, you've got everything from companies that own wireless towers, right? Cell phone towers, to office buildings, to apartments, to shopping centers. Is there one area that you think is really going to outperform in this environment?
Well, first, that's a great observation. A lot of times people think that the real estate sector is just about office. So the first thing is the office sector these days is only about 3% of the REIT sector. People are surprised by that, but that's because just like the equity market, the REIT market reflects the future of what we need in real estate. So senior housing, for example, is a big area that we like. Of course, we all know we're all getting older, whether we like it or not. But senior housing, these are businesses that are not reliant on Medicare or Medicaid. This is all private pay. And of course, we are entering baby boomers. Again, we're all getting older. They're entering I'd say the peak years of entering into senior housing. And coupled with that, we haven't seen a lot of new supply. So when demand's getting better again, it's not a cyclical thing. Everyone's getting older. When demand's getting better and we haven't had a lot of new supply, senior housing is an area we like. So healthcare REITs are more than 10% of the REIT universe versus, again, the 3% I just mentioned for office.
Yeah, great perspective. John, thank you so much for coming in. Really good to see you.
Thank you so much.
Well, Americans voted against the Joe Biden economy in 2024 with inflation and the perception of Democratic ineptitude clinching Donald Trump's presidential win. Just 1 month into Trump's presidency, however, Americans are gloomier than they were at the end of Biden's term. Joining us now, Yahoo Finance's Rick Newman, who wrote about this in the latest edition of Trumponomics. Good to see you, Rick. So I guess the Biden economy is looking a little bit different now.
Be careful what you ask for, I guess. Well, I mean, if you look at just a bunch of different measures we've seen in the last couple of weeks, consumer confidence now back down to the levels of last June or so, investor confidence down to levels of 2023. I mean, it's striking that after Kamala Harris of the Biden-Harris administration lost in November, we did see a little spike in consumer confidence. We know all along that voters gave Trump and Republicans in general higher marks on handling of the economy. But now we're only a month into the Donald Trump administration. I guess we're into the second month now. And we're seeing the marks going back down to where they were at pretty ugly times during the Biden administration, such as when inflation was raging. And this is happening as we're actually seeing not just strains on sentiment, but also some actual what might be some actual cracks in the economy. We've been talking about this a lot this week. Jobless claims are up. That coincides with Trump trying to fire all these federal workers. Maybe not a coincidence. How high do we really want unemployment to go? We're now seeing weak spending numbers. Some economists now predicting that we're going to have negative GDP growth in the first quarter. This is not random. A lot of this has to do with what we've been talking about incessantly, which is Trump threatening to impose tariffs, actually doing it in some cases, trying to kind of demolish the federal government, deport migrant workers. And this is having an effect on the economy. I mean, it is clearly starting to show up. So I think what markets want to know is how far does Trump really want to go here? Because right now we're in a game of chicken between Donald Trump and financial markets, and Donald Trump is showing no sign of slowing down.
Well, it's interesting, Rick, because there has been obviously this perception when you look at the survey data, the Democrats are a lot more worried about the economy right now than Republicans are. And so some economists have, I guess, taken those readings less seriously, perhaps because of that. How are you thinking about that disconnect that we've seen, which obviously is a absolute flip-flop of what we were seeing before the election?
Yeah. Right. So there's a political bias. It's now very obvious. There's a political bias in the way people view the economy, whether you're a Democrat or Republican. But the people who determine elections are not really Democrats or Republicans anymore. They're independents or people in the middle. That is also a very important voting bloc. And those people show up in surveys. And for the most part, they're not as gloomy as Democrats, but their sentiment is getting worse, not better. So if you just kind of call that the middle is getting gloomier too. And I think the thing that we really need to be paying attention to is when consumer sentiment, which is fickle, but when that actually starts to align with what we see happening in the economy and also with business sentiment. I mean, we are hearing from almost every direction at this point that businesses are putting investment plans, spending plans on hold. They're putting hiring plans on hold. Totally logical as you wait to see what is going to happen with these Trump tariffs. Are we going to get through just a period of sort of fanatical threats, and then it'll all kind of settle after 6 or 8 months, or is this just going to go on for the next 4 years? The U.S. economy, it's a remarkable engine, but it's fragile on the margin. And these sorts of things that Trump is doing, they are going to make a difference, and they're starting to show up, and they're showing up quickly. I mean, just for what it's worth, Trump's approval rating now is lower than Joe Biden's was at the same point in his presidency, and it has also fallen faster than Biden's approval rating. So maybe Trump doesn't care. Maybe he feels like he's king, but a lot of the rest of us care.
All right, thank you so much. Have a great weekend. Appreciate it.
Bye, guys.
Coming up, it's what to watch next week. We're going to get you set for everything you need to know to better position your portfolio. Stick around. Much more market domination still to come.
A Senate banking subcommittee held its first hearing exploring what a legislative framework for digital assets should look like. That happened yesterday. And that hearing was led by Wyoming Republican Senator Cynthia Lummis. She's a longtime crypto proponent and investor. And I spoke with Senator Lummis earlier today from that Bitcoin Investor Week conference. First, I got her take on the crypto environment right now, including the recent sell-off we've seen in Bitcoin.
It's not unusual for assets at this point in time after a change in presidency to pull back. It happens with stocks, bonds, oil, and other assets. So it's very typical in February after a new president takes office for there to be a slump. And so Bitcoin is participating in that slump. What will surprise me is if in the weeks to come, it does not recover. So I expect to see some recovery, certainly in the second quarter of 2025.
I do want to talk about yesterday's hearing because I'm curious if you agree with former CFTC Chair Timothy Masad, his testimony that sort of a legislative overall digital assets framework is less urgent than a stablecoin framework. Why would that stablecoin legislation be so urgent, and what's the status of it?
We will be moving stablecoin legislation first in the U.S. Senate, and then we'll move to market structure. The reason is stablecoins are the more plain vanilla asset, so we need to start with something that is backed by treasuries and agencies, and stablecoins are 100% hard asset backed by mostly fiat assets. We want to start there because when we move into market structure and later into other opportunities for Bitcoin, we have gotten a win under our belts legislatively.
And what about a Bitcoin reserve legislation? Because in your home state of Wyoming, for example, legislators rejected a state reserve. They were concerned about volatility. How do you sort of control for that if there's to be a federal reserve?
Well, we need to help people understand that short-term volatility is going to happen with Bitcoin. It always has. The goal of a strategic reserve is to buy or convert current assets into Bitcoin and then hold them. So the plan is acquire $200,000 worth of Bitcoin over 5 years and hold it inviolate for 20 years. That way, we can remove the short-term volatility from the equation and look at this as a long-term strategic asset and not something that can be rated for use in runaway profligate congressional expenditures and will be there for the long run 20 years hence.
And Senator, what kind of feedback are you getting from your colleagues on the Hill? Have you seen an increase in support for the idea?
Well, we've got more work to do. There is a favorable administration. President Trump has expressed interest in having a strategic Bitcoin stockpile. His administration is favorable to the notion. We have some work to do, both in the U.S. House and the U.S. Senate, in helping people understand the reasons why we should have a strategic Bitcoin reserve and how does it interplay with the world reserve currency status of the U.S. dollar. We think they're very complementary.
Do you think there should be any other types of crypto assets in that reserve?
Well, for my 2 cents worth, I'd like to have Bitcoin be the underlying strategic digital asset. We know that it can be held safely in individual wallets or by custodians. We know that it doesn't require a board of directors for verification. We know that it's fully decentralized. We know that it is an asset that will only have 21 million ever made. So its scarcity will give it value. Some of those criteria for what constitutes digital gold don't exist in other digital assets. So we need to be careful when we have a strategic reserve to be able to check the box in what's important in having a long-term strategic asset. And I think that some of the elements of Bitcoin are a perfect fit for a long-term strategic asset.
I also went on to ask Senator Lummis about the White House's effort to cut spending and whether Elon Musk's approach to cut costs has been too aggressive.
To Elon Musk about this, we know that the work of DOGE is to ferret out waste, fraud, and abuse. They're making tremendous progress. It's so impressive. The people on DOGE that are in these agencies are federal employees. They've been vetted the same as any other.
That's great. You've talked to the DOGE people. What about to your constituents in the state, though, who are losing their jobs? Have you talked to them?
Yes, I have. And here's what's happening. The short-term employees that are necessary to make our national park experiences enjoyable are going to be hired. There's going to be no change in the summer short-term employees. There's going to be no change in the number of firefighters and essential service providers. So it's going to be more the bureaucratic arm that will be affected by cuts, not the people that are front and center serving the visitors. So the visitor experience will not be affected.
And undoubtedly there is waste in the federal government. I think there's broad agreement on that. I think the perhaps quibble, if that's not too light a word, that some of the American people have with what DOGE has been doing is that it's applying a chainsaw rather than a scalpel, that it is doing bigger cuts to broad swaths of programs, USAID, for example. What concerns, if any, do you have about that?
Yeah, and let me tell you why it has to be that way. There are union contracts that protect federal employees from scalpel-like or more strategically placed cuts. So DOGE can't do it that way pursuant to contracts the federal government has with unions. The only way to reduce employees is the machete approach.
My thanks to Senator Lummis, who obviously was doing heroic work there, trying to hear me in a very loud conference.
All right, time now for what to watch next week. Starting off on the economy, President Donald Trump's 25% tariffs on imports from Canada and Mexico are taking effect on Tuesday. Trump citing the levels of fentanyl coming in from both countries as the reason for the tariffs. Additionally, Trump saying yesterday he is imposing a second 10% tariff on China.
Speaking of the president, Trump is also addressing a joint session of Congress on Tuesday, marking the first major speech of his second term. This coming after President Trump's meeting with Ukrainian President Volodymyr Zelensky today. What started as an economic negotiation wound up devolving into a heated exchange, leaving a potential mineral rights deal in limbo.
And moving over to earnings, it is another big week of earnings on the horizon, including CrowdStrike, Broadcom, and Costco. Costco announced results for its second quarter. That's on Thursday. Analysts expecting the company to post solid same-store sales growth driven by a strong holiday season.
And finally, February's full jobs report, it's coming out on Friday. Economists forecast 158,000 non-farm payrolls were added. That's an increase from January, while unemployment holds steady at 4% and hourly wage growth expected to slow to 0.3% on a month-over-month basis.
Now, between NVIDIA earnings and key economic data, it's been a busy week here at Yahoo Finance. Here's a look back at the week that was, in case you missed it.
Q4 was another record quarter. Revenue of $39.3 billion.
I'm more enthusiastic today than I was at CES.
I thought it was a good report. I thought it was a good call overall.
It looks like demand remains very, very strong.
This is a fantastic quarter from a company that is performing fantastically.
This is a decisive moment for NVIDIA. The technicals are saying we need a catalyst of some sort.
The IRS is cutting over 6,000 jobs in the middle of tax season.
Musk is clearly kind of entering a new phase here.
What the government is focused on is driving efficiency.
So by depleting the capacity of the accounts receivable of the U.S. government, you deplete the capacity to collect revenue.
You got income up, but spending down. That is a trend that continues. That could be a concern for the Fed.
Are we going to see an economy in Q1 that is exceptionally robust? No.
Recession risks are rising, but I think once the Fed gets on the right side of the 8 ball, recession risks will decline.